Good morning, everybody, or good afternoon, or indeed good evening, and welcome to this webinar on market sentiment. My name is Martin Essex, if you don't know me already, and I'm an analyst and editor here at Daily FX. I've worked as a financial journalist, I've worked as an economist, and I'm also a trained technical analyst. As you'd expect from that background, I trade by mixing fundamentals with technicals, with geopolitics, and indeed market sentiment, which is what this webinar is all about. And I should say at the beginning that these are my personal views, not necessarily the views of Daily FX or indeed of our parent company, which is called IG. Now, before we start, I'd like you to spend a few moments, if you wouldn't mind, just having a quick read of this. And thank you, Alexander, for telling me that you can hear me, which is always very useful. If you have any questions, please ask them as we go along, and I'll try to answer them towards the end of this webinar. I'll start, as I always do, with the charts and move on to what's coming up and on the diary and what the sort of various market sentiment indicators are showing. So we'll start, of course, in the obvious place, which is the euro against the dollar, which, of course, is the most widely traded currency pair. Well, this is interesting. You can see it's in a bit of a downtrend. And it has been in a downtrend since, when did it start? It started in September last year, and it's been going down pretty steadily since then. Coming up, though, to quite interesting resistance. The euro's gone up for 4 sessions now running, and it's quite close to this resistance line that joins these highs that we've seen since September. It's not a particularly strong resistance line. It's only got a couple of, it's only touched it a couple of times, but still in all, I think it's interesting, and we need to watch out whether the euro actually goes above that line. Anyway, let me talk about what's going on. So I would say that the main market story at the moment is, well, of course, it's the US-China trade talks, but also we're listening out for what Donald Trump is saying, both about Brexit and Huawei. He's currently in the UK at the moment. The Huawei issue is bound to come up, I think, when he meets the UK Prime Minister, Theresa May, and he's quite probably going to talk about Brexit as well. Anyway, the main story, US says China is still playing the blame game on trade. So it looks as though the two are as far apart as they've ever been, and that's really quite important at the moment. What else have we got? We've got pretty weak economic data, which I'll talk to you about in a moment or two. And this session, we've also got the chairman of the Fed, Jerome Powell, is speaking, so that could possibly influence markets as well. It looks as though the Federal Reserve is moving closer to a rate cut, 2, maybe even 3, who knows, before the end of the year. And the ECB meets on Thursday, and it's expected to be really quite dovish. So that's where we are at the moment, really. It's a sort of fairly poor background all in all. The trade wars, weak data, rate cuts, dovish central banks, it's all looking really as though the central banks and indeed the markets are looking towards, well, at least an economic slowdown and quite possibly a recession. So, not surprisingly, risk is off in the markets. Traders are looking for safe havens. There's an element of risk aversion here, and that's what we're seeing here, although we are seeing the euro rally, which suggests that things aren't perhaps quite as bad as they might be. I'll look at some of the other charts as well. So let's have a look at, let's have a look at the Aussie dollar as the next one. So this is, again, a daily chart. This is the Australian dollar. And I think what's interesting here is that it's still climbing, even though the Reserve Bank of Australia cut rates today to a record low. So that's really not the movement you'd expect. The Aussie actually pulling up, rising relatively strongly against the US dollar, despite the rate cut. It's broken through this previous resistance line to the upside, which is positive, and it's kind of heading towards that black moving average there, which is the 50-day moving average. And I guess that's the next resistance level there. So in other words, even though the background is very poor, even though people are talking about recession, it's not obvious when you look at the currency charts, because the euro is still rising and the Australian dollar is still rising, and those are both signs suggesting that perhaps this risk aversion has gone too far. Perhaps it's time that the markets will get their mojo back, and perhaps it's time that traders should consider buying some of those more oversold assets. Although having said that, if you look at this if you look at the RSI down here, the 14-day RSI, which suggests whether something is overbought or oversold, you can see it's actually right in the middle of the range, neither overbought nor oversold. So from that indicator, not necessarily the time to say, oh, well, things are okay, let's start buying back into risky assets. Let's have a look while we're here at sterling, which is always an interesting one to look at. And of course, because it's a trending currency. Now, I marked in here when those European parliamentary elections were announced. The Conservative Party did really badly in the in the European elections, and so did Labour. So we've got here this sort of big sell-off that came ahead of the elections, another sell-off that came afterwards, and that too is beginning to stabilize now. So yet again, another sign that, well, maybe things aren't quite as bad as they were. Maybe a few traders are beginning to dip their toes into riskier assets. So, well, not necessarily all that bad. Let's have a see if we get confirmation from the stock markets. So this is a daily price of Wall Street. Obviously, it's been lower. It's been falling since the beginning of last month. It's been down and down and down and down. But now, two sessions at which it's beginning to pick up. I should say this is yesterday, and this is pre-market trading today. It does look as though it's beginning to pick up. So again, we get this idea that although sentiment remains very poor, although the economic background is very poor, from a technical viewpoint, it does look as though things are beginning to pick up a bit. Let's have a look at the broader US stock market. This is the S&P 500, and you can see exactly the same picture. And one that I don't normally look at, which is the US tech stocks, and they are, well, still going down. You may know that there's well, it looks as though the authorities are beginning to think about whether the big FANG stocks, Facebook, Apple, Amazon, Netflix, Google, whether they have too big a market share, whether there's some anti-competition stuff going on there. So that caused quite a big sell-off in the Nasdaq index overnight, and it was looking weaker, the Nasdaq, than either of the other two main indexes. FTSE 100, which is one well worth looking at, London listed stocks, but international in scope, and they are also beginning to rise. Germany, the DAX, a little bit of a pickup. France, the CAC 40, a little bit of a pickup. So this is telling us the same story as, from a technical view, as the currencies are telling us. Risk is off, sentiment is poor, traders going into safe haven assets, but it looks as though, for now at least, there's just a tiny bit of bottom fishing, I suppose you could call it, and that's despite the economic data that shows manufacturing growth easing in both the US and the UK. I've written down here in my notes that positioning is perhaps now too bearish. Well, I'm not convinced of that. I think it's a possibility, and that means it might be a near-term buy opportunity. But on the other hand, there are other indicators that are not showing quite so much bullishness. So let me go back to currencies a moment and show you what's happening to some of the safe havens. Let's have a look at the dollar against the yen. It's always a good place to start. And there you can see the dollar still falling against the Japanese yen. So the Japanese yen is the currency that risk-averse traders go to. It's still falling despite that tiny pickup that we've seen this session today. So that's still looking bearish, which means that it may just possibly be too early to say that positioning is too bearish, but let's wait and see. The other one, the Swiss franc, the other safe haven currency, exactly the same picture, still falling, just a tiny bit of a pickup this session. But see, this would suggest the other way around, that even though there's a little bit of a pickup in risky assets, that there's still lots of people heading for the havens. That's the dollar, that's the yen, that's the Swiss franc. And let's again see what that's doing in some of the other markets. Let's go on to commodities and of course the spot gold, the traditional safe haven. Now that, I think I've said this several times already over the last few weeks, gold hasn't really picked up the way that other safe havens have. However, in the last week, it's done just that. It's begun to rise really quite solidly. And it does look to me there as though some money which was going into other safe havens is now beginning to find its way into gold. So those are all those are all the main safe havens. Gold, incidentally, note, is now at its highest for around 3 months. It was back at these levels back in towards the end of February. So March, April, May. Yeah, it's over 3 months it's been at these levels. So that's quite a negative signal for market sentiment generally, I would say. Let's have a look at Bitcoin, as I get asked about this every week, and see what's going on there. So Bitcoin, for some people, has taken over from gold as the principal non-currency safe haven, but this does now begin to have topped out. And it's interesting, I think, that gold is now rising, whereas Bitcoin, for the last couple of sessions at least, is beginning to fall. So perhaps people are moving back into that traditional safe haven, gold, rather than the newer safe haven, Bitcoin. That's where we are there. I want to look at one other chart that I sometimes call up, which is the bond yields. Now I'm going to go over to the site investing.com. So what we've seen as far, this is, I think, interesting. What we're seeing is that the US yield curve is inverting, which some people think of as a sign of recession. I'm not personally convinced of that, but anyway, if the US yield curve inverts, it's meant to be a sign of recession. The US yield curve has inverted. US yields are falling, German Bund yields are falling, and that's because people are going into the safe havens, US Treasury bonds, German Bunds. These are the sort of assets, these are the bonds issued by the safest of all governments, the top rated governments. So not only when they're a bit worried do they go into gold and the yen and the Swiss franc, but they also go into German Bunds and US Treasuries. Now that's not what this chart shows. This chart shows the US 10-year yield minus the German 10-year yield. Is called the spread, and you can see here that the advantage that the US dollar has over the euro has fallen dramatically. So back up here, the yield gap was around 255 basis points. It's now 231 basis points, and at the margin, that makes the dollar less attractive compared with the euro. I wouldn't say this was a major market factor. It's not something that's as important as the other things I've been talking about, but it's worth just keeping in the back of your mind that the advantage that US Treasury yields have over German yields is falling really quite sharply, and that makes the US dollar relatively less attractive compared with bonds. And of course, you have to, if you're overseas, you have to buy dollars to buy US treasuries, you have to buy euros to buy German bonds, and so it can affect the currency, possibly in that way. Worth remembering as well, of course, that we've got some important calendar events coming up that could affect things, most notably the European Central Bank this week, although it won't change interest rates, and also non-farm payrolls from the US on Friday. So that's where we are there. One thing that I haven't mentioned so far is oil. So let's have a look at that. And where's my charts? There they are. So let's go back onto commodities and let's have a look at not gold this time, but US crude. And you can see there, well, this very steep fall in US crude oil prices. This is the WTI, West Texas Intermediate contract, and the same is true of Brent crude, which is the global benchmark. So you can see very steep falls in the oil price. That, of course, is because weakening global demand will reduce the demand for oil, and of course a recession would reduce the demand for oil even more, and that's really shrugging off Saudi comments about cutting output. There's an OPEC plus meeting coming up. All these are things that you might expect to lift the oil price, or at least to keep it sort of trading sideways, and it's not. The oil price is falling, and I think that's the other really interesting thing that's going on at the moment. So that's where we are now. Let's have a look at what's coming up on the calendar. So here I'll go on to the Daily FX website, and here you can see our top stories on Bitcoin, which makes change. It's a while that's been our top story, but there it is at the moment. Anyway, I'm going to go into our economic calendar and just have a quick run through what's happened this week so far and what's expected this week in terms of forward-looking indicators. So to repeat, as I always do, the private sector indicators, the unofficial indicators do tend to look forward. They tend to give you some ideas of what's coming up, whereas the official data tends to tell you what's already happened. So that's why I think we need to look at these upcoming figures. Now, this is the first week of the month, and the first week of the month brings the purchasing managers indexes. So in this context, I think it's important to look at market sentiment, which I've been looking at before, but it's also important to look at business sentiment, manufacturing sentiment, service sector sentiment, consumer confidence, and so on, because I think all these things can move currencies. At the top of there, if you can see it, it says the Japan PMI manufacturing, but note this is a final figure, and the final figures don't tend to move markets. It's the provisional figures that tend to move them. So I'm going to move on from Japan, and the first one here that I can see that looks interesting to me is this one, which is China. So yesterday we saw the China manufacturing PMI for May. So this is, for those of you who don't know about it, these are people who buy stuff for their companies are asked about their ordering, and they come up with this company called Markit, M-A-R-K-I-T, produces these PMIs where anything over 50 means expansion, anything under 50 means contraction. So the manufacturing sector of the Chinese economy in May, just above that 50 break-even level. 100 is expansion, 0 is contraction, 50 just on the edge, just above that level separating expansion from contraction. But I think you could say it's as near to 50 as makes no difference. So just it does look as though the Chinese economy is just holding steady at the moment. We got some more PMIs yesterday as well. So we got these from the Eurozone, which I'm going to ignore because they were final figures, and look at the UK one, which was a provisional figure. So this is the manufacturing PMI for the UK, and that came in, well, surprisingly below 50, and that really is important, I think. So we were expecting a small dip from 53.1 to 52.2. It actually came in at 49.4, below that 50 break-even level, and really quite disappointing. And the US ISM, so this is the equivalent for the US. There is a manufacturing PMI there, but it's the final figure. This is the one I'm looking at here, which is the Institute for Supply Management's figure. It's a high impact figure, and look, it's well below expectations. So it was at 52.8. It was expected to rise to 53. It actually fell to 52.1. So both the UK and the US manufacturing sectors and really not doing as well as people were expecting, and that feeds into this whole idea about global economic slowdown and talk of recession, if nothing else. Nothing much today to look at on the calendar, so I'm going to go straight to Wednesday. And now, having had the manufacturing PMIs, we now get the service sector PMIs. So this is the one for Japan, second down on the page. There isn't a sort of consensus forecast among economists from that one, so we can't really tell what it's going to show. But let's look at the China one, and here the China services PMI for May. So previous one was the manufacturing sector, this is the services sector. Expected to be a little bit down, I guess. Looking at the manufacturing figures, you might expect this to actually fall a little bit more than expected. So then we have this whole bunch of Eurozone figures. Remember, well, the Italy one is new, but the French and German and composite ones are all old, so that's nothing much there. But the UK, again, is a new one. Services PMI expected just a tad higher, and that makes the composite PMI expected a tad higher. So again, looking at what we've already seen, I suspect the risk there is to the downside. So all in all, it remains pretty negative. The whole sort of background remains pretty negative. So having said that, now might be the time for bottom fishing, to pick up some bargains, or whatever phrase you like to use. I'm still not convinced, quite honestly. I think that perhaps it might be better to wait just a little bit longer. Right, let's have a look at our own sentiment indicators. So if I go back to the top of this page and go into our home page, and here in the middle of the page, you can see our own sentiment indicators. So DailyFX, as I said, is a subsidiary of IG. IG allows traders to position themselves in the markets, and we gather all that data together. How many traders are long, how many traders are short, and we take a contrarian view. So if there's a big signal that long positions have shot up or short positions have shot up, we take a contrarian view. We look at both where they're positioned and the changes in positioning, and look for opportunities. So let me click on here where it says sentiment, so I can show you in the middle of the page like this. And the signals, well, a mixed signal for euro dollar. But now this is interesting, I think. From a contrarian basis, bearish on sterling. Well, yeah, fair enough. Bearish on the dollar against the yen. So that means that there's a signal there to buy the yen, which is a safe haven. But here you get a bearish signal on gold, and you also get a bearish signal on Bitcoin. So again, this kind of feeds into this very mixed picture. So if this is suggesting that the yen will go up, gold will go down, Bitcoin will go down, and as I keep saying, I wouldn't use these on their own, but this is what these are saying. It's just that traders really don't quite know what to do at the moment. Now, I know as an analyst, I should be telling you what is going to happen next, but I don't have a crystal ball. All I can tell you is that we seem to be nearing a bottom as far as risk sentiment is concerned. It does seem as though the risk off move could continue, but it could also be running out of steam. And there's a bullish signal there on Wall Street as well. I usually at this point show you our the more detailed figures. So go to here, the sign up, log in to DailyFX Plus, go into IG client sentiment, and there you can see a whole bunch of reports. We file those once or twice a day. this is the latest report that was filed yesterday by my colleague David Rodriguez in New York, and there'll be a new one up today. I won't go through this in any detail, but because I do this every week, and you're probably fed up with me saying this, but this chart here, this little chart here is useful, I think, because it tells you where the big changes are in long and short positions, and then you can go down to read more detail here. And as you can see at the bottom here, you probably can't see if you're looking on a mobile, mixed euro-dollar trading bias. I might as well look at just see one or two others that have moved substantially. Looks like dollar CAD has moved quite a lot, so let's have a look at that. So I shall find USD CAD and see what that says. So yeah, so retail trader, sorry, I said I wasn't going to go into this in any detail, but this looks interesting. Retail trader data show 30% of traders net long. The ratio of traders short to long at 2.29 to 1. So in other words, shorts much higher than longs. Traders have remained net short since May the 22nd, when dollar CAD traded near 134.019. The price has moved 0.6% higher since then. Well, this actually shows how this works, because if traders have remained short since that time, the price has actually moved higher. I'm not saying that the traders who use this are wrong. I'm just saying that crowd sentiment is often wrong, and that's why it's useful to take a contrarian view. Retail traders, that is. I think I was asked last week whether you should take the same view of the COT data. So that's the commitment of traders report that we get from the US CFTC, Commodity Futures Trading Commission. I wouldn't take the same view as that, because I think this is about retail traders, and I think what professional traders are doing, large speculators and so on, is very different. But anyway, this does show that this is working. And so what does it say at the moment? The dollar CAD price trend may soon reverse lower, despite the fact traders remain net shorts. In other words, if dollar CAD is reversing lower, that means strength for the Canadian dollar. Right, let's go back to our home page. So I shall press home again. That doesn't work. 1 second, let's come out of this and go up to the top and go here. You can go to Daily FX Home by just looking at that one there. So let me have a look at some of these questions. Alexandra again, right. I had a look at the changes and where those signals are coming from, and those safe haven moves seem to be mainly profit taking. Yeah, I think you're probably right. I think there is some profit taking going on, and that certainly makes a lot of sense. If people are just saying, okay, we've moved from riskier assets to less risky assets, maybe now is the time to just to take some profits and think about where to go next. I certainly wouldn't argue with that. Running out of time again. Let me, sorry about that. Let me just show you our education section, because I think this is really useful. Go into education here, this tab here, and into Forex University, and lots of information to help you trade, because I keep getting emails from people saying, you know, what did I do wrong? And you know, I thought this was a, you know, I started off with so much money, I've now got this much money, what should I do? Well, I'm not going to give you trading advice on an individual basis, but I would say, for heaven's sake, read what it says here about how to trade. Whether you're a beginner, whether you're not, just read what it says here, because otherwise you are going to lose money. Anyway, that's about all I've got time for today. I hope you found that useful. I'm not going to be here next week because I'm going to a wedding in France, so I'm taking the time off. I will be back, other things being equal, the week after. So thanks for listening. Hope you found that useful, and I will no doubt talk to you again soon. Goodbye for now.